Hi, I am Jim Jackson, and I am bonding over bonds with my colleague Kevin Kazi. Kevin, we've experienced very volatile markets over the last several months. There was some optimism earlier in this summer that the Fed was closer to the end of its hiking cycle, but the market environment has changed dramatically over the last month.
Yeah, it sure has, Jim. Inflation and the Fed's reaction are the two primary drivers. We have seen the Treasury curve flatten. We've seen higher yields, all due to the expectations of a more aggressive Fed and more entrenched inflation.
And Kevin, it's not just the Fed. Tighter monetary policy is a global trend. Also, the disruption in the European energy market has impacted economies globally, and we've started to see that bleed through with negative earnings revisions in the third quarter. So this is clearly impacting U.S. corporate earnings.
Yeah, we've seen some really big moves in both Treasury rates and corporate bond spreads. The result of this is higher yields in Treasuries as well as corporate bonds. In fact, bond yields right now are higher than the dividend yield of the S&P 500. And this is something we haven't seen since 2021. So valuations of fixed income are looking very compelling.
You know, Kevin, we think in a market like this, it's worth it to step back and gain some historical perspective. Within fixed income, the 2-year Treasury yield as we end the quarter here is approximately 4.2%. The yield on investment-grade corporate bonds, as measured by the Bloomberg U.S. Corporate Index, is about 5.6%. These are yields that we haven't seen in more than 10 years, and they're multiples higher than the yields we were seeing at this time last year. We think this is a favorable indicator for fixed income investors. So thank you, Kevin, and thank you for joining us as we bond over bonds.